think I'm live. So I'm live on Facebook. I am live on Instagram. I am live on YouTube. And I think that I'm live on LinkedIn. And I'm live on LinkedIn. All right. So happy Monday. And today is our daily tax topic. So we are going to be talking today about tax advantages of different entity structures. And so I love this topic, and we're on day 6 of our 12 days of Taxmas. And so the tax code is Taxmas 6. So if you guys are not on our mailing list, make sure you get on our mailing list because they already got this and people are definitely buying this. This is my #1 selling course, and it's a course on business entity structures. And what I'm going to be talking about today is business entity structures. So today I'm going to talk about the tax advantages and understanding the tax advantages of different entity structures. Because this is a live, it's about 15 minutes. I do not have time to go through every single thing, but this course goes through everything, and I definitely talk about this topic a lot. So if you guys have been around for a long time, you guys know that I do talk about this topic a lot. So who am I? My name is Atia Brown. I am the owner of The Savvy Accountant. It's a CPA firm where we are savvy at solving your tax issues. And I do love all things tax. And so my goal is to help you build wealth by reducing the #1 expense that you pay, which is your taxes. So let's get started on tax advantages on different entity structures, what you guys need to know, and how it works. So the first thing I want to say is that there are different entity structures, and because there are different entity structures, taxes work differently. So I know with this series of lives I've been talking about, there are different types of taxes that people pay, and a lot of times everybody knows about income tax. That's the main one that people know about, but there are a lot of different taxes that you pay, and especially as a business owner, so you need to understand that you pay different taxes. And with that said, that different entity structures that you are in is going to dictate the different types of taxes that you do have to pay. And so understanding that different entities are going to bring about different tax implications is going to be important. And when I'm talking about these entities, what am I referring to? So I'm referring to sole proprietor, because I hope you guys know that a sole proprietor is an entity structure. You're allowed to be a sole proprietor and do business. It does not mean that your business is any less substantiated than another business. You're still going to get your business expenses, and you can just be doing business in your own name, and that's fine. Is it recommended? No, because liability litigation purposes, it's probably best to have yourself separate from the business. And so that's where single member LLCs come into play, where it is going to have the same tax implications. So for a single member LLC, the government calls you a disregarded entity. And what that means is they're taxed the same way. So the same way you're allowed to claim deductions and stuff on the income that you earn, it's going to flow to your Schedule C on your 1040. All of that stuff is going to still be there. But when you have an LLC that's put in place, that does give you a buffer between the self and the business. And so should there be any litigation because you're now an entity, a separate entity from yourself, you're able to sue and be sued in that entity name. So the next entity structure that we do talk about is going to be a partnership. And that's typically when you have more than one partner. It's like an LLC, but you have more than one person on there. And so that's why it's not a single member LLC, and it's considered a partnership. You can also have the corporation, which a lot of people think just is only applicable to, big box entities. That's not the case. You can start your business at your state level, and you can be a corporation. You can elect to be a corporation. That's going to dictate and have other tax implications that it doesn't have under the other entities. And an S Corp is an election that you can take, and what it stands for is a subset of a corporation. And so that's typically why I talk about it after a corporation, because a lot of times S Corps are gaining in popularity, but I like to call it kind of like a hybrid. And so I think that the S Corp is a hybrid between the first set of entities that I talked about and the corporation. And so I like to talk about all of them before I get to the S Corp, because it's kind of a hybrid. It kind of gives you the best, some of the best and worst of both sides. And so I think that's the purpose that it was created for. And so That's why I like to talk about it in that order. So the order that I talk about it is not the order of importance or anything like that. It's just the order that I think it makes most sense, going from sole proprietor, and then as you go up, and then the subset of the corporation was created later on. So business structures are going to dictate your taxes. And so you're going to have different taxes under the different entity structures. So you're going to have your income tax. So that's going to be across the board. The rate that you pay for your income tax is going to be different, obviously. And the next point that I want to talk about is how your entity structure impacts your personal taxes. So if you guys have done a training with me, you would have seen my diagram when I talk about entity structures. And I usually start with the entity, and then I start with the personal tax return and how the personal tax return is impacted. So when you're a sole proprietor, or a single member LLC, your personal tax return is impacted because that's the only return that is filed, right? So you file your 1040, and then you have the Schedule C that's attached to it. So all of the tax implications are actually on the personal return. Whereas when you are a partnership, or when you're a partnership, or give me one little second. Whew, okay, so my daughter just got home from school, and I had to let her in. So when you're a partnership or an S corp, these two I'll talk about together because the actual tax return, both of those entities have to file a separate tax return. What we call is an informational tax return. And an informational tax return means that you file it to the government, but there's no taxes imposed at the federal level, because in each of those, the entity is going to generate a K-1 tax form, and that K-1 tax form is going to go to the individual. So either the partners, the number of partners, or the members of that S corp, they're each going to get a K-1 form, and that K-1 form is going to be what you take to your personal 1040, and that is where the taxes are going to be implicated on the federal level. So you need to understand that your personal taxes are going to be impacted by entity structures as well. And the next one is the corporation. So the corporation is the one where the corporation files its own tax return, and it is assessed taxes at the federal level for the corporation. So the corporation is going to pay its own taxes, whereas the partnership and the S corp, they don't pay taxes at the federal level, right? So the corporation, and that's how it's different, the corporation is going to pay taxes. And depending how the owners of that corporation, depending on how they were paid. So they could be paid with dividends, they could be paid a salary. Then the individual is also going to be taxed. So the individual, when they file their 1040, they will be taxed as well. And that's where the term double taxation comes in. Whereas with a partnership and the S corp, without getting into it too much, because this is a 15-minute live, the owners and the partners, the members and the partners can be paid different ways. So under the S corp, you are going to take what we call a reasonable compensation. That means you're going to have to be on payroll. So you're going to get a W-2. So the individual at the 1040 level will get a W-2, as well as the K-1 from that S corp. And so that's how your business entity structure is going to impact your personal taxation. So it's not something that you can look at opposite of a silo, where you can look at it separate and think that it has no impact on one or the other. They typically are going to impact both. So you want to make sure that you are looking at both scenarios to see how it's going to be impacted, so that you can choose the best entity structure for yourself. The next topic I want to talk about is changing your entity structure for tax purposes. So because I just talked through the different entity structures, you would imagine that there's going to be some pros and cons of each of them, right? And so you are able to elect to change the way that you're taxed in your entity structure. So that could be by changing your entity completely, just electing to be taxed a certain way. So you can be an LLC and you could elect to be taxed as an S corp. You can even be a corporation, elect to be taxed as an S corp. So there's different ways that you can elect these things. You just need to make sure that you meet the deadlines to change these things. But it can be, so you're not set in stone just because you started an LLC. You're not set in stone because you decided to start the C corp. Even if you're a partnership, you can elect to be taxed differently. So you can do an analysis, figure out the best way that's for you, and get taxed that way. The fourth thing that I want to talk about is a case study that we did with one of our clients. And this case study is going to show you the importance of entity structures. So we had this client who came to us, they started a business and it ended up doing extremely well. I don't think anybody could have predicted how well this business would make. This business went from making something like 38,000 one year to like 4 million the next year. It was a crazy jump and it was a blessing. It's an amazing. But when they started off, they were a single member LLC. They thought that was the best thing. That were like, oh, I need to start a business. So they started as a single member LLC. They were going to have to pay a lot of taxes because as single member LLC, one of the additional taxes that you do pay is something called self-employment tax. So when they came to us, it was in December of that year that they came to us. So we were able to only do one thing. So we do work on tax strategy on how to reduce your tax liability, but they came to us so late in the game, we were just able to get that entity structure taken care of. And by changing that entity structure only, we were able to save them $203,000 that first year. And that was the goal. They just wanted to save the max that they could with that one tax year because they knew that they came at the end of the year, but 200,000 is a good savings, right? So that shows you that your entity structure does matter and you want to make sure that you are in the right entity structure that's going to give you the best tax advantages. So if you guys have any questions on this, and this is one of my favorite things to talk about, I will try to answer them in the comments. But because today is day 6 of our 12 days of Taxmas, we are training on how to select the best entity structure for yourself is available. It's a 50% off. You just need the code TAXMAS6 and you guys can get that link. If you are on Instagram, you can just DM me the word Taxmas and the link will be sent automatically. Or you can message me wherever you guys are watching this and the link will be sent in the comments. But I hope you guys enjoyed this conversation. I hope you guys now know that your entity structure does matter and it's going to impact your taxes. So that was our live for today. I do see a couple questions here. Let's see. What are some major determinations for switching from an LLC? So it's really going to be the tax benefits. So I would always say that you need to do an entity structure analysis. What that entity structure analysis does is it takes into consideration your goals, what your business is doing to see how much you're going to be saving, because it's really going to come down to the tax savings and what your goals are. But that's a great question. You need to just make sure that you can see tax savings and then it outweighs whatever any other costs that are associated with that switch. But making sure that you know your numbers and that you can see what it's going to actually save you, that's going to be where you start. But working with a professional, going over your goals, that's going to be kind of the first place to start figuring out when it's time to change and what you should be changing to. So I hope that answered your question. But like I said, this is going to be posted, and so you guys can ask your questions on the comments. And so that's it for our live today. I hope to see you guys tomorrow, where we'll be talking about, what are we going to talk about? Another favorite topic, hiring your children in your business. Can this be done? So join us tomorrow, and we are going to go live talking about that topic. I'll see you guys tomorrow. Bye.